I'm going to be talking to Dr. Jean-Francois Mercure, who is a senior lecturer in global systems at the University of Exeter in the UK, and lead author on Reframing Incentives for Climate Policy Action that was recently published in the journal Energy Nature. Now, this paper is creating a lot of buzz in my circles, and I'm very anxious to talk to him about it. So welcome to the interview, Jean-Francois.
Thank you.
Well, look, let me briefly summarize your argument, if I can. So your argument, what you've modeled here is that importing fossil fuels, but specifically oil, in this case, be focus of our conversation, is very expensive for importing companies. And with the price of electricity falling with renewables, it now becomes more economic for countries to generate electricity domestically that can then replace oil imports, electric vehicles. That then sets up a scenario where competitive oil producers like Saudi Arabia, for instance, then shift their strategy from keeping the price up to grabbing market share as peak oil arrives and then begins to decline. So they want to grab market share. That then forces less competitive or uncompetitive oil producers like the Canadian oil sands into this downward spiral of becoming less and less competitive and all sorts of economic problems that come along with that. Have I got the argument correct?
Absolutely, yes.
So now this has been around for a while. I ran into this argument, I think, 4 or 5 years ago with Spencer Dale, the BP economist. But your paper is significant because this is the first time that it's really been modeled as diligently and rigorously. Do I understand that correctly?
Yes. So not many people do the kind of work we do. We model technology development with a huge amount of detail, 88 or a lot of different sort of technologies that people use, and then the global energy system, the flows of oil and gas and coal and renewables as well across the world, who uses it for what application, in which country. And then we look at all these flows over time. We look at the current trajectory and the new trajectories that could be adopted with policy and look at where things are going. We have no interest in particular politics or policies. We just tend to use that to inform policymakers, and this is what we're finding.
Right. Now, I do a lot of reporting on electrification of transportation. And I just interviewed Bloomberg NEF's transportation analyst recently, and they're busy adding, increasing their forecast for EV sales. We've really got it. We're just into now exponential growth. They say price parity is coming as early as 2024, 2025. And I mean, the stars seem to be aligning to support your argument.
Okay, well, it's really great to hear that from BNEF, and I believe that it's true. That's also what we're finding in terms of price parity. It depends which country, what the policy is, whether cars are imported or whether they're domestically made, and whether there's support from the government. And overall, some countries will see this break-even year come fairly soon, 5 to 10 years. And after that, it becomes a bit of a no-regret option for many people to just go and buy electric vehicles, save money on that, save money on the lifetime use of petrol and diesel. And these consumers won't realize it, but the fact they're not buying petrol and diesel means that all this oil is never needs to be produced in countries where they produce it. And of course, that has knock-on effects all the way up to Canada and Russia and the countries that have more challenging extraction environments, such as the Arctic or the tar sands or deep offshore and so on.
So I've done a lot of reporting on the oil sands, so I'm curious about your take on your assumptions there. They've recently reported that their break-evens in terms of West Texas intermediate prices have fallen down to the $30 to $35 a barrel range and are on their way down in the next 5 years to maybe the $25 to $30 a barrel range. Would that not make them at least competitive again, in the short to medium term? Maybe not long term, but short to medium term?
Yeah, I think there's two things going on there. There's the fact that the clearly less competitive sites will have been shutting down anyway, so that obviously makes the average go down. And there's also the fact that, well, in our data, which is extremely detailed from the company called Rystad that gathers all this data over oil and gas sites, 40,000 across the world. It's not what we're seeing for Canada. But of course, if we shut down the less competitive ones, then the average falls. And I can imagine that they feel a lot of pressure to make their operational costs go down in order to be able to remain in the market. Otherwise, they just have to declare bankruptcy. So I can imagine that they will try to stay alive. But what's important to remember is that there is too much oil around in the world if we look at what's going to be demanded going to 2050. And however competitive they may try to be, if there's too much oil around, the price is just going to go down further. So as far as we can see, the Middle East has enough oil to power most of the oil demand going to 2050, if the major economies decarbonize as they have indicated they would in the Glasgow Agreement, for example. And therefore, I think that Canadian oil might remain superfluous or marginal in that market.
Right. Now, I gather, so what's going on here is that the price of electricity is going down, the price of electric vehicles is going down, production of electric vehicles is going up, and the pace of that will go, it'll go at a certain pace. But then again, we have now more and more aggressive climate policies by governments, and policy will speed all that up. So the more aggressive the policy becomes over time, then that will speed up the switch from oil to electric. And I assume that was part of your analysis.
That's right. Yes, we looked at many different possible futures, not to play politics, but to really look at the various ways things could play out. What's clear is that the importers of oil have this incentive to rapidly wean themselves off the dependence on oil, and that has a big impact on their economies. If they do so, then we have this scenario where we considered Europe plus East Asia completely eliminates their emissions by 2050, 2060 for China. And in that scenario, this removes enough of the oil demand that it will definitely affect the producer countries. And of course, if all the countries went for net zero, which may or may not be likely, but is possible, and now we could consider India as well in net zero in 2070, then that pushes things down further. And I think it's quite likely that those countries do so just on the basis of helping their domestic economies. Of course, things could change and politics could get in the way, but nevertheless, I think that a growing market for oil is now becoming quite unlikely. It's going to definitely peak by the 2030s, I think.
What's your take on the demand driven by growing Asian economies? This is often pointed to by supporters of the oil industry. They're saying, well, yes, we know that gasoline and diesel demand has already peaked in Europe. It's very close to peaking in North America and so on. But Asia is going to fuel at least, if not growing demand for oil, then still a large market, even up to 2050. What do you make of that argument?
Well, so China, out of all the countries we could discuss, I think, which is of interest, has obviously the fastest growing energy demand in the world, or one of. But they also happen to have the fastest growing renewables park or developments in the world. And they also have the fastest growing electric car fleet in the world. So in some sense, they have everything biggest in the world. But the rapidity at which electric mobility is growing in China, it should really alarm people, because that's really going to take a big dent out of their demand for oil, which could really rapidly peak. And if there's further policies to eliminate fossil fuels use in heating, for example, that could also have an impact. And then there remains questions about industrial use of oil, which is the remaining components. And that could also change rapidly. I think that we have to be realistic in thinking. We have to look at, for example, BNF data is a good example to look at where things are going before we make any bets on investing more into oil and gas infrastructure, in order to be sure not to lose out and end up with stranded assets.
Right. There's a policy area here I'd like to get your comment on, Jean-Francois, that interests me a lot. And that is this idea that if we're in an energy, we are definitely in an energy transition, and your paper explicitly acknowledges that, then if we're moving from this economy of the 20th century into the economy of the 21st century, where wind and solar and electric vehicles and batteries and software and AI and so on are all the components of the new economy. And if you want to be competitive, you have to make that switch. And we see China and Europe and Japan and Korea and the US, the North America doing that. Then the faster you get there, the better, the more competitive you are vis-a-vis these other countries. And so it seems to me that countries take climate policy out of the mix entirely. Just from a competitive point of view, countries really want to make that transition to electricity and an electric economy as quickly as possible. What do you make of that argument?
Yeah, so if you look at Tesla, for example, it's the most valuable car company in the world now. It's more valuable than all the other car companies combined. Apparently, they crossed the $1 trillion threshold. I think that's telling us something about where things are going. And if the solution to such a problem is diversification in the economy. So you look at Canada, and clearly, if there's uncertainty about the fossil fuel sector, the oil and gas sector, then there needs to be diversification happening. And where are the high value industries coming? We can see them. We can see not just the renewables industry, but everything to do with new tech and batteries. And we need to have a part of that in Canada, in the US, in Europe, in order to not miss out. And there's a clear danger that all the technology becomes manufactured by China and the Asian economies, and that would lead to sort of a gradual economic decline in the Western countries. So I would say that, so in some sense, our modeling is a bit pessimistic in that we don't assume what happens to innovation and new technologies and where that's manufactured in so much detail. We sort of assume that every country is making their technology. But of course, if it's all made in China, it's going to be very detrimental for all the Western economies. So there's a really big case for looking at industrial policy to see what sort of economy we're going to have in the future.
Now, your paper argues that under your modeling shows that half of all fossil fuel exports in the world will be uneconomic by 2036. And that's that's much quicker than like the International Energy Agency and other forecasters have predicted. So give us a timeline of how this might unfold getting to 2036 and then what might happen from there on to 2050, please.
Well, so for us, we see the world is in a sort of demand-led driven way. So it's we look at the demand first, the technologies consuming fossil fuels and how they're changing and how. So what we're seeing is that by at the current rate of change of technology, by the 2030s, there'll be a large amounts of the current technology that will have transitioned on its own to a low carbon form, whether that's heat pumps, whether that's electric vehicles or say power generation technologies. And then there's a big question as to how quickly that's going to accelerate, whether or not we have the climate policies that aim to achieve the targets, for example, in the Paris agreements or in the sort of Glasgow pledges. But whether or not this is met, the world is still changing and the demand for these fuels is still peaking, such that past 2035, things are in a downwards trend for the oil and gas sector, and the coal sector will have been finished quite a while ago by then. And by then, companies operating in oil and gas need to look at a future in which their activities are shrinking. And that's a very difficult thing to do for companies in general. There are big questions now as to how they should diversify as well before we get to that point. But I don't think that even with the lobby power they have, the oil and gas company can force people to consume fossil fuels if they are transitioning in their end use. For example, once you've bought an electric car, you have petrol's of no value to you. And that's really the way things are going to change.
Right. And it seems to me, Jean-Francois, like we've argued at Energy Media, that the 2020s are the really, really disruptive decade of the energy transition. This is when everything The window is open. The industries are being disrupted. The window is open this decade to make transitions. But after 2030-ish, if you haven't begun to make that transition, you're behind. And it's very difficult to catch up after, say, 2030. So if you work back in your analysis, what happens in the next, between now and 2025 on policy, on capital investment, on labor training, all of those things is really, really critical. Would you agree with that?
Yeah, absolutely. The problem with having an economy that's out of sync with the rest is to end up with stranded assets or investment that's in the wrong direction or misplaced, and no return on investment or losses. And that's really a big problem. So obviously, at some point, it'll become clearer to every policymaker in the world where things are going and where they should be investing. But there could be in the coming decade, in the 2020s, some lack of direction by a lot of investors and governments, which could lead to big problems. For example, if a country such as Australia, for example, is putting its money on expanding coal mining, it's possible the demand never materializes for this coal, and that actually it was just the wrong place to invest. And I think that the 2020s are really crucial to get the direction right in terms of not just for environmental reasons, but just for economic reasons.
Right. And a final question, Jean-Francois, and that is, there's when we talk about the energy transition, very often that conversation is dominated by concerns of workers, maybe around a just transition. Environmentalists very often are dominating the conversation in the media, because my media colleagues are talking about climate policy and so on. We're just beginning to really, in the last year or two, talk about capital and investors. Because it seems to me that if there is a danger of stranded assets, it's investors and capital that they're like the canary in the coal mine, right? They're worried about this. They're looking out at the future. And what we're seeing is capital is flooding into tech and it's and less into fossil fuels. And B, capital is telling the fossil fuel industry and oil in particular that we see you as a risky industry and you need to up your returns to us to cover that risk, and we know we're less likely to give you capital, those sorts of things. That seems to be the message is coming through loud and clear, and we're just not listening to it.
Yeah, I think that's true. And I mean, I sympathize for every country and policymaker in countries where there's a large fossil fuel industry that's at risk, because it's very difficult to manage. But my group has done a separate study to this one, which is connected, and we're just studying human capital in particular. And what we find is the value at risk of human capital is a lot larger than any physical or financial capital, if you like. So the skills in the workforce are at risk because we may end up with a skills mismatch. And this is real people, ultimately. So we need to consider what's going to happen to people if the economy changes so rapidly, and what they're going to be doing. I mean, in Canada, for example, you've already had people from the provinces in the Atlantic going to the Midwest to work in the oil industry, and then that gets stranded. They may again face similar difficulties as they had when the fishing ended in the Atlantic provinces, for example. And what's going to happen with workers in Alberta now is an interesting and really important question to address. But these are real people. We have to remember that it's something to have financial losses, and it's something to have a lot of people losing their jobs. But if the oil demand is not there, then there's not a lot that people can do to protect those jobs, and therefore there needs to be a plan for what to do with all of these workers. It's not their fault if their industry is going to go into decline, but it's quite likely to happen, and therefore we need to start thinking afresh about how we're going to do how we're going to protect people and their livelihoods.
Well, Jean-Francois, thank you very much for this fascinating paper, and I look forward to future conversations with you about your work.
Thanks very much.